The world of finance, a high-stakes game of risk and reward, thrives on trust. Investors bet on companies, relying on the integrity of markets. But what happens when this trust is shattered? Recently, the Securities and Exchange Board of India, or SEBI, uncovered a brazen market manipulation scheme orchestrated by a prominent TV anchor and his associates. This case sent shockwaves through the investor community, exposing the vulnerability of the system to greed and deceit. The alleged mastermind, a household name in financial news, used his influence to artificially inflate the stock prices of select companies. His pronouncements, broadcast to millions, held sway over retail investors. Unbeknownst to them, these weren't objective analyses but calculated ploys to line the pockets of the conspirators. Market manipulation, a deceptive game, relies on creating illusions. The perpetrators employed a range of tactics, each designed to mislead investors. First, they pumped up stock prices through a coordinated buying spree, creating an artificial sense of demand. The anchor then went on air, touting the supposed growth prospects of these companies, further fueling the frenzy. To lend legitimacy to their scheme, they planted fake news articles and social media posts, echoing the anchor's rosy predictions. Unsuspecting investors, swayed by the manufactured hype, piled into these stocks, driving prices even higher. This created a classic pump-and-dump scenario, where the manipulators, having inflated the bubble, sold their holdings at the peak, leaving retail investors to face the inevitable crash. The fallout from such scams is devastating. When the manipulation came to light, the stock prices of the targeted companies plummeted, wiping out the savings of countless small investors. Many, lured by the promise of quick riches, had invested their life savings, only to be left with nothing but regret and a sense of betrayal. Beyond individual losses, such incidents erode trust in the entire financial system. Investors, burned once, become wary of participating in the market. This chilling effect can stifle capital formation and hinder economic growth. Moreover, such scandals tarnish the reputation of the country's financial markets, making it harder to attract foreign investment. SEBI, the watchdog of the Indian stock market, acted swiftly once the manipulation came to light. They launched a full-blown investigation, using their surveillance mechanisms to track the suspicious trading activity. SEBI unearthed a trail of incriminating evidence, exposing the intricate web of deceit woven by the anchor and his accomplices. The regulator didn't hesitate to wield its enforcement powers. They slapped hefty fines on the perpetrators, proportionate to the scale of their illicit gains. The anchor, stripped of his credibility, faced a ban from appearing on television, his career in ruins. His associates met a similar fate, their reputations tarnished, their futures uncertain. This scandal serves as a stark reminder that even in a regulated market, risks exist. Investors must remain vigilant, relying on their own due diligence rather than blindly following self-proclaimed gurus. Independent research, a thorough understanding of the companies one invests in, and a healthy dose of skepticism are essential tools in navigating the treacherous waters of the stock market. Regulators, for their part, must remain proactive in their surveillance, constantly evolving their tactics to stay one step ahead of the manipulators. Strengthening investor education programs, promoting financial literacy, and fostering a culture of transparency are crucial steps in preventing such scams from recurring. The fight for market integrity is an ongoing one, demanding constant vigilance from both regulators and investors alike.